Hello and welcome again to another solo 401k session with my solo 401k financial. If you have questions or topics that you'd like to discuss, please chat those over now so that we can be sure to get to them all. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Again, welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic is the $83,250 opportunity every solopreneur needs to know for 2026. Again, this is your chance to get answers. Please use the chat now to ask questions on today's topic or anything else. We also ask you if this information is helping you to feel more confident about your future. Please like this video as it'll help us to get the word out to others like you, other solopreneurs, other advisors who might need this information to help secure their retirement or the retirement account of their clients. Okay, great. So again, if you got questions or topics, let's chat those over now. We can be sure to get to them all. We'll go through the ones that have already been chatted up in advance. Then we'll go through the slides and we'll circle back to any more that get chatted up in the meantime. So the first one's from Barry. Thank you so much for joining, Barry. We always appreciate your good input and questions. Can your clients deduct your fees on the business tax return and claim the auto enrollment credit, or is it considered double dipping? So the answer is yes. There's nothing in the auto enrollment credit guidelines that would indicate that you cannot deduct the cost. And it makes sense in the sense that unlike the startup cost credit, which is a different credit that was authorized under the Secure Act to encourage businesses to start up a 401k plan, the auto enrollment credit, which is a credit that's not just available to new plans, but even existing plans that are upgraded to our plan can claim the credit. But unlike the startup cost credit, where the amount of the credit that can be claimed, as the name indicates, is a function of the startup costs, the auto enrollment credit is a flat credit regardless of the costs. So if we were talking about the startup cost credit, no, you cannot both deduct and claim the credit per the guidelines and the guidance. But there is no such guidance indicating that one wouldn't be able to also take a deduction for the costs of setting up and maintaining a plan that includes the auto enrollment feature. Great question, Barry. Thanks for bringing it. Now let's go to Matthew. Matthew's question is, my wife has an LLC taxed as an S corporation that I participated in during 2025, but didn't take pay. I also have 1099 income from a consulting business that I started in 2025. Can we open a single solo 401k plan under the LLC and I still be eligible to contribute voluntary after-tax contributions based on my unrelated 1099 self-employment income? What about employer contributions? Great questions, Matthew. So the starting point is just eligibility. So a solo 401k plan is a one participant plan. So there are exceptions to that one participant requirement. One is for spouses that are working in the business. So if you have two spouses, and even if one spouse is the 100% owner of the business, if that person's spouse, the non-owner, is working in the business and reporting their own earned self-employment income from the business, like you, for example, you could participate in the solo 401k sponsored by the spouse's business, assuming that there are no non-owner, non-spouse employees working for any business owned by either spouse. So that's what allows you to participate in the solo 401k. Now, once you are participating in the solo 401k, each spouse can aggregate from all sources of self-employment income. So even if they've got other sources of self-employment income, they can aggregate, they can use that other self-employment income to justify contributions to that same solo 401k plan. And all types, whether we're talking about voluntary after tax or employer contributions, etc. Hopefully that helps, Matthew. Thank you for bringing the good question. So now let's spend some time with the slides. So again, we want to talk about the $83,250 opportunity every solopreneur needs to know for 2026. And so really what we're talking about are the new contribution limits for 2026. So let's first start out with eligibility. We can circle back. We've got time to talk more about the benefits generally. But let's talk about eligibility, because that's always the foundation. And we kind of alluded to it and discussed it when we talked about Matthew's good question. But a solo 401k plan, like any 401k plan, is for an employer, but specifically it's for a self-employed individual. So solo 401k is really an industry term, or you could say it's a marketing term. The technical term is a one participant plan. So it's really for a one-person business, or what they call an owner-only business. And there's really two elements, two parts of the eligibility criteria that need to be satisfied. One is the individual needs to report earned self-employment income. So that's how you prove that you're self-employed. So you can't just have investment income, right? You'd have to have earned self-employment income, because it goes back to the foundation. Like all 401k plans are for people who work, right? So if you're self-employed, you got to have earned self-employment income. That's the first piece of this eligibility equation. And earned self-employment income is income that's reported on Schedule C. That would be the type of earned self-employment income. Or W-2 wages that are received from a business taxed as an S Corp or a C Corp. Or if the business is taxed as a partnership, earned self-employment income would be income reported on line 14 of the K-1 that's received from the partnership. Now, the other piece of the eligibility equation is that it's an owner-only plan. It's a one-participant plan. So that means that there cannot be any non-owner, non-spouse, full-time W-2 employees working for any business owned by that self-employed person or a spouse, if any. Some of the eligibility considerations include, do I need a separate entity? The answer is no. You don't have to have a formal legal entity. We have many, many customers, for example, who operate without a formal legal entity. For example, they operate as a sole proprietor. Now, they do need to report earned self-employment income, and that would be income reported on Schedule C, for example. In the case of a sole proprietor, there is no minimum amount of earned self-employment income that they would need in order to be eligible. So solo 401k plans are not just for, bigger self-employed businesses. Even micro solopreneurs can set up a solo 401k as long as they meet both of the eligibility criteria: reporting earned self-employment income with no non-owner, non-spouse, full-time W-2 employees working for any business owned by that person or a spouse, if any. Now, their spouse or business partner can participate. That's one of the exceptions to that one participant rule. Is it another owner, as long as they're at least a 3% or more owner, or a spouse, as long as they're reporting earned self-employment income? So the spouse doesn't even need to own part of the business in order to be eligible. In either case, they can also participate in the plan, and it's still considered to be a one participant plan. It's still considered to be a solo 401k. In addition, side hustlers are eligible. In other words, you can have a W-2 job and set up a solo 401k for your side self-employment income, even if you participate in your W-2 employer plan. So even if you participate in your day job 401k, if you've got separate side self-employment income with no non-owner, non-spouse employees working for you, you could set up a solo 401k for your side hustle. Now, let's skip through the use cases. Again, we can talk more about the benefits generally. And let's get to the $83,250 opportunity that every solopreneur needs to know for 2026. So this is referring to the contribution limits. So for 2026, those contribution limits go potentially all the way up to $83,250. So how could you potentially get there? Well, you'd have to be age 60 to 63, because that means that you'd be able to make an $11,250 catch-up contribution. So the way that the contribution rules work is that you have the overall contribution limit that applies to all types of solo 401k contributions. And then you have different buckets that you can fill up. And so a solo 401k plan does have the highest contribution limits available to any self-employed individual in terms of defined contribution plans. And that's because the solo 401k is going to allow the self-employed individual, the solopreneur, to make different types of contributions. So contrast with a 401k that someone might have in corporate America at a day job, where they can only make employee contributions. But when you're self-employed, in the words of the IRS, you wear different hats, right? You're both the employee and the employer. So you can make different types. So that's why a solo 401k does have the highest contribution limits for any defined contribution plan available to solopreneurs. Now for 2026, the overall limit increased from 70,000 to 72,000, thanks to inflation. And then on top of that, there are additional contributions that can be made over and above the overall limit for those that are age 50 or older. So for example, if you are age 50 or older, you could make a catch-up contribution, and the standard catch-up contribution amount is $8,000, but there's a special super catch-up contribution limit that does apply if you're age 60 to 63. So if you are age 60 to 63 and you have the self-employment income to justify the contribution, you could potentially contribute up to $83,250. But even if you're not in that age where you're not eligible to make a catch-up contribution, you can still contribute a relatively high amount, potentially up to $72,000. So for those self-employed individuals, for example, who might be looking to catch up on their retirement savings, this can be a powerful way to do that. Now let's go through an example so we can kind of see how the different buckets work. So focusing on 2026. Now remember, a solo 401k has the highest contribution limits available to self-employed individuals, and that's because you can fill up different buckets. You can make both the employee contribution plus the employer if you got the self-employment income to justify it. Now, in addition, our solo 401k plan, the one offered by my solo 401k financial, allows for tax diversification. So what do we mean by that? Well, traditional 401k contributions, those go in on a pre-tax basis. So they reduce your taxable income for the year for which you make the contribution. Whereas if you have a plan like ours that allows for it, you can also make Roth contributions, which do not reduce your taxable income for the year for which the contribution is made, but you to a Roth account, it has that potential for tax-free growth. And there's different ways that you can make Roth contributions with our solo 401k plan. So you've got the standard Roth contribution, which is the employee contribution. But in addition to that, you could also make what's called the mega backdoor Roth contribution. And that would allow, for example, our clients to contribute up to $72,000 for 2026, where the funds end up in a Roth account, or even more if they're age 50 or older. But let's assume that you want to diversify from a tax perspective. In other words, you don't want to necessarily put all your eggs in one basket. You might want to make some contributions as a Roth contribution, where you've got that potential for tax-free growth. And then in other contributions, make as a pre-tax contribution to reduce your taxable income now. So, for example, for 2026, if you have the self-employment income to justify it, and we're going to be having deep dive discussions where we really go through many different scenarios here in the coming weeks, but we'll really see how it works for many different scenarios. But just to give us a simple example, for 2026, with our solo 401k plan, you can make the employee contribution as a pre-tax contribution or as a Roth contribution. The 2026 employee contribution limit is 100% of your self-employment compensation, dollar for dollar, up to $24,500, plus an additional $8,000 if you're age 50 or older, or if you're age 60 to 63 during 2026, instead of $8,000, you can make an $11,250 catch-up contribution. And if you have the self-employment income to justify it, all of those contributions could go into a Roth account. And then on top of that, our plan allows for profit-sharing contributions, employer contributions. Some people think of it as a matching contribution. It's technically not a matching contribution because matching contributions do not apply to a solo 401k. Instead, solo 401k plans allow for profit-sharing contributions. They're also referred to as non-elective contributions. Now, those employer contributions historically were always made as pre-tax contributions. That was how they had to be made. They had to be made as pre-tax contributions. Thanks to Secure Act 2.0, you can technically now make those employer contributions, if you have a plan like ours that allows it, as Roth contributions. However, for our customers who want to maximize the dollars that go into a Roth account, they would typically skip making employer contributions as Roth contributions and just simply make mega backdoor Roth contributions. But in this case, we're assuming this individual wants to diversify from a tax perspective. And we assume that they made 100% of their employee contribution as a Roth contribution. So let's assume that they want to make the rest, the employer contribution, as a pre-tax contribution, which would reduce their taxable income for the year for which the contribution is made. Now, that employer contribution limit is a percentage of your self-employment compensation. So you need the compensation, the income to justify the contribution. Like all contributions, you need the income to justify it. But unlike the employee contribution, where you can contribute 100% of your income dollar for dollar up to the limit, for the employer contribution, it's a percentage. So the percentage that applies depends on how the self-employed business is taxed. For example, for a business taxed as an S Corp or a C Corp, the employer contribution percentage is 25% of the W-2 wages that are received from the S Corp or the C Corp. Whereas if the self-employed business is taxed as a sole proprietorship or a partnership, your ability to make employer contributions is limited to 20% of your self-employment compensation. So if you got the income to justify it, you can max out. You could go all the way up to $47,500 in this scenario as a pre-tax employer contribution. So you can see how you could get to those higher limits. Now, another great feature of a solo 401k plan is that you've got tremendous flexibility in terms of the timing of making contributions. So unlike a corporate day job 401k plan, where the employer needs to deposit the employee's elective deferrals right away, for self-employed individuals, you've got time. So as long as the plan was established by the end of 2025, you would have preserved the ability to make all types of contributions for 2025, whether employee, employer, and or voluntary after tax, by your 2025 business tax return deadline, including any timely filed extension. And even for those that did not set up a plan by the end of December 31st, 2025, here in 2026, you could still set up a plan in 2026 and make 2025 contributions. Now, you won't have the ability, you won't have the maximum flexibility and options like those that had established the plan on or before December 31st, 2025. But you would still have a lot of good options on the table. For example, if your business is taxed as a sole proprietorship, you could still set up a plan in 2026 and make all types of contributions for 2025, whether employee, employer, or voluntary after tax. But you would need to make the employee contribution by April 15th. If you filed an extension for your 2025 business tax return, in other words, your 1040, that would give you more time to make the employer and the voluntary after-tax contributions for 2025, but you would not be able to extend beyond April 15th in terms of making employee contributions for 2025 if you didn't set up the solo 401k until 2026. Now, for others, for example, for S Corps, for C Corps, for partnerships, who first set up a new solo 401k in 2026, it's too late to be able to make employee contributions for 2025, but there's still time to make both employer and voluntary after-tax contributions. You would just need to set up a plan here in 2026 in time to make those employer and or voluntary after-tax contributions by your business tax return deadline, including any timely filed extension. Now, of course, for 2026, there's plenty of time, right? Because here we are in January of 2026. All that needs to be done is to sign up in 2026 with my solo 401k financial, and that'll lock in the ability to make all types of contributions for 2026 by your business tax return deadline, including any timely filed extension in 2027. Okay, wonderful. So now let's go back to the questions. Thank you so much for checking out this session. And again, if this is helping you feel more confident about your future, if this information is helping you with your solo 401k planning, please like this video, as it's going to help us to get the word out to other solopreneurs just like you, other advisors who might be looking to get this important information to secure their retirement. In addition, we invite you to subscribe. Please subscribe, whether you're on LinkedIn or YouTube or X, as that way you'll get notifications of when we go live. We go live twice a day. We were live earlier. Now we're back in the afternoon session. We go live twice a day. We bring content. We answer questions. So we invite you to subscribe so you can come live and ask questions or just hear the content that we come to share. So now let's go to AP's question. I'm a client of yours. In 2025, I had 4 types of transactions in my solo 401k housed at Fidelity. Pre-tax rollover from old 403b. Pre-tax contributions of $10,000, $30,000 to after-tax converted to Roth. I invested $100,000 from the pre-tax to the real estate syndication. What paperwork do I need to complete for tax filing for this year as well as for record-keeping purposes? What do I need to provide to you? And you'll provide relevant documents versus what documents do I need to create on my end? Wonderful questions, AP, and thank you so much for your business. Now, from a solo 401k perspective, when you make a contribution to the plan, that could be a pre-tax contribution, an after-tax contribution. When you roll over money to the plan, for example, from a former employer plan like a 403b, that is not reportable by the plan. Contributions are not reportable by the plan. Rollovers are not reportable by the plan. Now, contributions would need to be reported as applicable on the personal tax return or the business tax return. So, for example, voluntary after-tax contributions do not need to be reported. They don't need to be reported by the plan. They don't need to be reported on the personal tax return or the business tax return. It's optional to report it on the W-2, for example, if your business is taxed as an S Corp. Rollovers, those would be reportable by the administrator of the account from which the money was transferred. So by the 403b provider, they would need to report that on a Form 1099-R, and you want to make sure that they report it with a code G in box 7. So you'll get a copy of that 1099-R from the 403b provider. That will help confirm that it's a non-taxable direct rollover. So you'll see $0 in the taxable box. You'll see code G in box 7. Now, moreover, when you invest money from your solo 401k, one-off specific investments do not need to be reported by the solo 401k provider. But that doesn't mean that you're done. There are situations here that may need to be reported, that do need to be reported. So first of all, what does need to be reported? Well, when you make a mega backdoor Roth contribution, that's really a 2-step process, right? You've got the voluntary after-tax contribution. That's how you take advantage of those higher voluntary after-tax contribution limits. But then those voluntary after-tax solo 401k funds need to be moved from the voluntary after-tax solo 401k account to either a Roth solo 401k or a Roth IRA. And I just stated that the first step, the voluntary after-tax contribution, that doesn't need to be reported on the personal tax return or the business tax return. But the second step, when you move the funds from the after-tax solo 401k account, either to a Roth solo 401k or a Roth IRA, that does need to be reported on a Form 1099-R. Needs to be reported for the year of the transfer. Now, customers, clients will let us know via online forms on our website, right? We don't have access to our customers' accounts. We don't provide the accounts. So they need to let us know in a timely fashion, and then we'll prepare that 1099-R for no additional charge. So if you didn't let us know and you transferred this from the after-tax to the Roth last year, you want to go ahead and let us know now here in January so we can get you in the queue to have that 1099-R issued. So if you go to mysolo401k.net/forms and pick the applicable form, then submit the information to give us what we need, you can enter the date of the conversion, and that's the year for which the 1099-R will be prepared. So even though it's now here in 2026, if you enter 2025, that is the year for which the 1099-R will be prepared. Now, that's what does need to be reported, is the after-tax to 1099-R transfer. What may need to be reported will be if the value of the solo 401k as of December 31st exceeds $250,000. And keep in mind, if you have a defined benefit plan, you also have to include the value of the defined benefit plan in determining whether that $250,000 threshold has been met. But once the value exceeds $250,000, customers or their advisors just need to let us know, and then we'll add their plan to the queue to prepare the 5500 EZ that needs to be filed. That's an informational tax return to report information about the plan as of December 31st. So we'll guide you through that 5500 EZ filing process, where we end up filing it under the electronic filing system, the EFAS system, to make it easy for all parties. Okay, wonderful. Great question, AP. Thank you so much for bringing it. Okay, so we'll just spend a moment on some of the top benefits, or let's spend a moment on some of the top use cases, and we'll see if any more questions come through. So the frugal investor, once the value of the plan, as we learned from AP's question, exceeds $250,000, there's going to be an informational filing requirement, the 5500 EZ, and we include that as part of our services for no additional charge, and that would really be for the large account holder. So that would be the use case there. So customers, their advisors, again, just have to let us know in a timely fashion, and then we'll prepare the 5500 EZ for no additional charge. Keep in mind that if you work with some other parties, like a CPA, a lot of times they'll charge easily hundreds of dollars to do that 5500 EZ. And if it's skipped, if it's ignored, the late filing fee is $250 per day. So it's a no-brainer. Roth Maximizer. Well, our plan gives you all the tools to maximize the Roth. So you've got some basic plans offered by Fidelity, for example, Schwab, where they're now forced to allow you to make Roth catch-up contributions, so employee contributions, but they don't support mega backdoor Roth. They don't support employer Roth contributions. They don't support in-plan Roth conversions, where you take pre-tax dollars that are already in your solo 401k and you move it to a Roth account, whereas our plan does. So for the true Roth maximizers, you've got to go with a plan like the one offered by my solo 401k Financial. The frugal investors, we get it. We are also self-employed individuals. And so we know that you need to get value for your dollar. So we were the first solo 401k provider to offer a plan that's eligible for the tax credits. $1,500 per year, $1,500, $500 per year for 3 consecutive years, for a total of $1,500. Those are tax credits, not tax deductions. So that's a dollar for dollar reduction in your tax liability, which ultimately means it's going to more than cover our fees for the first 7 years. We charge $650, which includes the $525 establishment fee plus the first $125 annual fee as the initial cost. Then starting 12 months later, we charge our $125 annual fee that covers the second year. So it's a flat fee regardless of the value of the plan, regardless of whether you need the 5500 EZ or the 1099-R. So you know exactly what you're signing up for. And if you added up all of our fees over the first 7 years, it wouldn't even amount to $1,500. The alternative investor. So many of our customers, they have experience not just on Wall Street, right? They might be a realtor who wants to diversify into real estate. So our plan would allow that. Of course, it allows for traditional brokerage type investments like stocks, bonds, mutual funds, but it also allows for true alternative investments like real estate, private placement, private stock, crypto, precious metals, notes, the rainy day investor. Another great use case. Our solo 401k plan allows for solo 401k participant loans. This is where you can literally withdraw money from your solo 401k and use it for any purpose whatsoever. Could be used for a personal purpose, a business purpose. Now, it's not going to be subject to taxes or penalties as long as it's documented as a loan, as long as it's within those loan terms, paid back according to the required repayment schedule. So we handle the loan documentation as part of the service for no additional charge. The terms are going to require that the loan is limited to no more than 50% of the balance, not to exceed $50,000. It's paid back in either monthly or quarterly payments, equal payments of principal and interest. The interest is prime plus 1% or a CD rate plus 2%, with those payments spread over a 5-year term. Okay, great. Thanks for letting us go through some of those top use cases. Back to AP. To recap, pre-tax rollover contributions, no reporting needed. Yes. After-tax to Roth conversion. Yes. Not the initial contribution, but the subsequent second step of the mega backdoor Roth. The transfer to the Roth is reportable. Real estate syndication investment, no reporting. Yes. If it matters, my solo 401k is set up as one participant, sole proprietor. No, it doesn't matter for purposes of these issues that we're discussing. Great. Well, it looks like that takes us to the end of the session for today. We really appreciate all the engagement. We really appreciate all the great questions. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement.